Hello, everyone. Welcome. Thank you for joining us. My name's Jen Fries. I'm the Community Engagement Manager for the Harvard Federal Credit Union. And today we are going to be talking with Dennis Sexton from our office and our investing side about managing finances in times of uncertainty. So just for you to know, those of you in the audience, we are in webinar mode, and that means that we cannot see you in the audience. We cannot hear you, so you can go ahead, have your lunch, take care of your kids, do whatever you want to do. We definitely can sorry, we won't be bothered by you. Sorry. For questions on this webinar, you're going to be using the Q&A feature, and sometimes, so not the chat, but the Q&A. Sometimes you can't see it on your Zoom toolbar, and sometimes you have to go all the way to the right of the Zoom toolbar. There's 3 dots that say more. Go into more and jump into the Q&A, and you will see that you can leave us a question. You can do a question anytime during this presentation. You are welcome at any time to do that, and we'll get to most of the questions at the end. But if something's particularly relevant at the time we're talking, maybe we will address it then. If you want to go in and test the Q&A, you can go in now and just let us know where you're joining us from. We always love to hear about that. This presentation is being recorded, and you will get the slides. So everyone who's registered is going to get the recording sent to them. It's posted on our YouTube, and we'll get the slides, so you don't have to write everything down either. And we will also send you a post-workshop survey. So we will ask for your honest feedback about how we did and what we can do better. So today we're going to go through sort of what does it mean to have economic security. Dennis is going to talk you through a little bit about investing strategy, including retirement planning, which for many of us is the major portion of our investments, although of course, you know, people build wealth in all kinds of ways, and Dennis can talk you through all of those. So again, my name's Jen Fries, and this is my team. We are the community engagement team at the credit union. We are all certified credit union financial counselors, and we are here for you and work closely with folks who are interested in getting some financial education, financial wellness. So please feel free to reach out to any of us. And then I'm delighted to be joined by Dennis Sexton. He is our investment advisor here at Harvard Federal Credit Union. He brings over 30 years of experience in the financial services industry, most recently at TIAA Wealth Management. So for those of you who are joining who might participate in the Harvard retirement plan at TIAA, he does know a lot about that and can give you some pointers or tips on that. But he is here to help our members with your retirement planning, strategic asset allocation, wealth transfer strategies, offering sound and suitable investment advice that's tailored to your goals. If all that is very complicated and you don't know what that means, don't worry, we're going to cover a lot of that today. So
sounds good.
Yeah, and basically Dennis is going to take you through with a holistic approach. So just a little bit about the credit union for those of you who don't already know. We are Harvard Federal Credit Union. You may know us by our prior name, which is the Harvard University Employees Credit Union. But now we're known as Harvard FCU. We do everything that, what is a credit union? We do everything that a bank would do. You know, you can have your checking account, savings account, your CDs, credit cards, all the different things that you would expect from a bank. But instead of being owned by shareholders and having to make a profit for shareholders, we at the credit union are owned by our members. So when you become, open an account with us, you become a co-owner and a member of the credit union. And you can bank with us anywhere. You know, we have the online banking, we have the app. So even if we don't have a branch right near you. However, if you do want to bank in person, you can come in and do what's called shared branching nationwide through a network of credit unions and co-ops. So you can go and do banking in person that way. We also refund all of the fees that you might pay if another credit union or bank or financial network charges you a fee at an ATM. One of the ways that we try and give back to our members is that we refund those fees. So there is really easy access to the credit union, even if you can't get to one of our specifically branded ATMs, for instance. Okay, into the meat of the presentation. I do want to talk a little bit about living below your means. And what does that mean? Many of us have heard that phrase before, but you may not know what it refers to. So living below your means is a suggestion that is going to set you up well for financial wellness. We like to cover some of this before we get too much into investing, because you don't want to get the cart before the horse, or you don't want to get too far ahead of yourself. There's certain basics you should have in place before you start investing. So one basic is to try to live on 70 to 80% of your current salary. And the rest of the money is going to be for saving for goals or paying down debt, depending on where you are. You may want to devote even more of your current salary to savings, depending on your goals, or to achieve financial independence earlier. So it may depend on, obviously, what your circumstances are, but you never want to be spending everything you're earning, basically, because then you're just setting yourself up for a cycle of being in debt, and particularly being in credit card debt. So that would be step one. So this slide is what we call the waterfall slide. So you can picture it's as though money starts at the top and then is flowing downhill as you meet that step. So this is, we don't know what the future is. This webinar is about navigating financial uncertainties. One of the only things that we can do when the future is a little, volatile seeming or confusing, so we can prepare ourselves for ups and downs and get ourselves in a position where we're well cushioned and we have some ability to sustain ups and downs. So this waterfall is going to get you to a place where you have a good starting point. So in the beginning, the first step, obviously, of financial wellness is going to be, can you cover your monthly expenses? If you can't, it's going to be a process of trying to figure out how you can decrease your expenses or increase your income. And we'll give you some suggestions at the end about that, and some great resources for help with financial counseling. If you're in a situation where you're not yet doing that, then we have some ideas for you. Mm-hmm. But once you're covering your monthly expenses, then you want to be starting an emergency fund. And this is not investing. This is a high yield savings account where you're going to get a decent interest rate. We have one at the credit union called Smart Rewards, but it can be at any bank, credit union, financial institution. You want to start saving up an emergency fund, starting with aiming for 1 month's expenses. So again, it may take you some time to get to that, but you want to be in a situation where eventually, over time, you get to the point where you have 1 month's expenses in the bank. Then you want to be sure that if your employer offers a retirement savings plan that has a match, and that's when they tell you, oh, if you put X amount into your retirement plan, we will match it. Then you want to be getting the employer match. As soon as you have that 1 month of savings, next step is to get the employer match, meaning you put the amount into your retirement plan that is required in order to get the employee match. And the reason is there's no investment in the world where you're going to get 100% return immediately, except for getting the employer match. So I put in $1, I get $1 up to a certain amount. So you want to be putting in up to that amount, and maybe it's 3% of your salary. If you're on the straight Harvard plan, it is unusual where you don't need to put anything in. They just contribute. So that is a little different. But most other employers, you are going to have to put some skin in the game, some money in to get it. The next step is going to be to pay off high interest debt. Typically, this is your credit cards. You want to you want to pay off your credit cards every month. And if you can't do that yet, then you want to start of the amount that you're not spending every month, that 20 to 30% that's extra after you're living below your means. You want to be pouring that money into paying off high interest debt. Roughly anything, I don't know, over 7%. It can differ, and Dennis can talk you through that a little bit more, but certainly credit cards, perhaps student loans, depending on what the interest rate is. But some of your student loans you can just pay at a graduated rate, and we will give you student loan counseling, free services at the end of this presentation also. Once you have your high interest debt paid off, then you're going to increase your emergency fund, typically to 3 to 6 months of your expenses. Only then are you ready to think about investing, because investing has a risk of loss. The market goes up and down. You need to be able to weather those ups and downs. And, you know, in order to meet your goals with investing, you don't want to be pulling money out when it is the market is down, for instance. You want to be able to, if you have some, I just had a huge car repair yesterday. Extreme bummer, but I took
so sorry to hear that.
Yeah, it wasn't a happy time. My heat shield fell off my car and it's old. Anyway, I took money out of my savings. I didn't have to cash in investments and look at, is the market up, down, that kind of thing. So that will cushion you and protect you. So yeah.
Before we move, while we're on this slide, Jen, I just want to interject a little bit. So I come into play at 2 points on this waterfall.
Yep.
One is get employer matches. So as Jen mentioned, I was at TIAA for the last 6 years. It's a big reason Harvard hired me, because I have knowledge of the TIAA retirement plan, which is very, very generous, but it is also complex. So if you have questions about that, I can help you. And then down at the end, when you've hit all these, steps on the waterfall and you're ready to invest extra money, only after you've filled all these other buckets, we can talk about investing outside of the retirement plan. But right now, due to volatility, even that, I would suggest that you do periodically, and not plug a lump sum of money from, say, inheritance or something like that into the market in one shot. So we can talk more about that later.
Yeah, so you could help people strategize about it, particularly if you do have a lump sum or something that you need to plan for. That's an ideal time to check in with an advisor and kind of get your ducks in a row.
Right.
So again, we talked about those emergency reserves. Those should be in a high yield savings account. This is sometimes known as paying yourself first. If you've heard that phrase, it's because immediately, as soon as you get paid or as soon as you have income, you put a percentage into savings. And that can either be that you set up your direct deposit can go to more than one account. So you can immediately put 10 or 20% of your paycheck by direct deposit into your savings. You can also do it as an auto transfer on a periodic basis, like you get paid on Thursdays, every Friday it transfers a certain amount into savings. So that's what people mean when they say pay yourself first. You want it to be liquid, insured, and accessible. And we do offer all of that, obviously, at Harvard FCU through our Smart Rewards savings. I'm a member, and that's where I keep my emergency savings. It's a great option. And you can also look for other high yield savings accounts at whatever your financial institution is. So then that other step on the waterfall of managing debt is, again, you always want to be paying more than the minimum on your credit cards. So if you only pay the minimum payment on your credit cards, you will never be paid off. So that's a disconcerting thing to learn. Ideally, you want to be paying off your credit card in full every month. But not, you may not be there yet. That's okay. If anybody on this call is in debt, that's a very normal thing. It happens to a lot of us at different times in our lives. And we do have a resource. The next slide, I'm going to give you a resource about financial counseling, including help with making a plan for getting out of debt. So, in these like volatile times too, sometimes, with the tariffs and the price of groceries, sometimes you end up putting things on credit that you wouldn't before. And I think, controlling how much you are charging obviously is another strategy for managing your debt. As you pay off one card, don't just say, oh, now this is money I don't have to worry about anymore. Again, apply that payment directly, the amount that you were paying to one card, put it toward the next card until you have them all paid off. So that step of the waterfall is going to be really important for you to get out from under feeling like you're always behind. If you're in that situation, for those of you on here. So again, I promised you several times free financial counseling. You do not need to be a member of the credit union to use GreenPath. GreenPath is a nonprofit, and they provide free counseling in many languages, extended business hours. The free financial counseling will be related to credit, debt, budgeting. Like if you don't know how to make a budget, how do I figure out, setting aside 20 to 30% of what I earn. They can do housing counseling around like saving for a house. They also can do student loan counseling. They're federally certified federal student loan counselors. So if you have, a complicated situation where you want to figure out, am I on the right repayment plan or any of that? I know that a lot of people in the Longwood campus have student debt. GreenPath can help you with that. I really encourage you to reach out to GreenPath for a check-in or for regular counseling. They're here for you. And again, you don't have to be a member to access this. So go ahead and take advantage of GreenPath. I see that one of my team members has put the link into the chat. Thank you. Okay, so this is the point where we've gone through the whole waterfall, and I'm turning it over to Dennis, or we can talk, together here because it's a conversation. But you've gone through the whole waterfall. You now have that 20 to 30% of your salary to invest in your goals, right? So I know for me, my goals have been investing to save for retirement. And I also, in the past, did a lot of saving in a 529 plan for my daughter's college.
Sure.
So those might be real typical ones, but you may be saving for a house or any of the other things that you could be investing for.
No, exactly right. So time is on your side is a great way to to put this. When you're starting out, I wish I could go back to be the age that probably some of the audience members are. But starting young really is the best thing you can do. Putting anything at all that you can afford to into the retirement plan, especially, is critical, especially in light of the generous match that you get in the Harvard plan. As Jen mentioned, there's no investment I'm aware of. I've been looking for one for a long time. I've never found it where you get 100% return before the mutual fund does anything at all. Even if it gets zero, you have 100% return on the Harvard match. That's, just don't give that up. Get into the plan. We do have the unusual situation where Harvard puts in money anyway.
Yes.
So that's unusual.
Which is great.
which is great. But definitely get in there and get your Harvard match. To illustrate the fact that
I do want to say different people at Longwood campus have different retirement plans. So
okay.
Okay. People on this call may have and don't you can go ahead and put into the Q&A if you have any questions about your particular plan.
Well, if some of you are in some of the hospital, retirement plans, those are also excellent. TIAA also, had a hand in some of those. So I'm familiar with those as well.
Yeah.
So, to illustrate investing over the long haul, let's meet Iris and Lucas. So if we look at just starting investing at different times, you can see a dramatic increase in investing, just 10 additional years. Remember, you're buying, I'm going to get into this later, but you're buying into the market at all different times through your periodic paychecks. You're buying lots of shares when the market's low, only a few when it's high. I'll get into a lot more detail on that. But if you're doing that for 10 additional years, look at the difference, 242,000 versus 117. So the biggest advantage you have is time, regardless of what the market's doing. And when there's some volatility, it's actually a good time to be investing periodically. So we'll get into that.
Sorry, I didn't mean to.
No. That's
yeah. And I think that one of the nice things about this is it's only $100 a month, and there were plenty of times in my life that was all I could manage. And still, that makes a big difference for, your future. So no matter when you're starting, it's the right time to start now,
Yep.
as opposed to later. So,
No, absolutely right.
okay.
So we've got a few principles here. I'm going to get into a lot more detail on each of them, but diversification is the idea that we need to invest in lots of different things. Small cap stocks, mid cap stocks, large cap stocks, not just the S&P 500, which is the 500 largest companies. A lot of the performance of that index is driven by the Magnificent Seven, as they call them, the seven largest companies in there. So diversification is the idea you should be in something broader than that. I would say more like the Russell 3000, or there's a very good fund available in most of the plans that you are in. The Vanguard Total Stock Index Fund, CREF Stock from TIAA is also a good one, where it does this for you. It invests in, basically those 3,000 companies within one fund, which is neat. The other way to do it, you can go on an app called Morningstar, and they will show you all the different funds you need to buy into. Problem is, not all of those may be available in the plan. So sometimes it's better to just do the one fund that buys a little of everything.
Yep.
More on that later. Asset allocation is the science. So basically, diversification is the concept that you should be invested in a little bit of everything. Asset allocation is the science of applying that concept to your particular retirement plan, which might differ a little bit from the MGH Brigham plan to the Harvard plan to some other plan. So if you have any questions about that, I can help you. Dollar cost averaging is the concept that I alluded to a few minutes ago, where if you put in money out of each paycheck, you automatically buy a lot of shares when the market's down, very few shares when it's up really high, moderate amount somewhere in the middle. Over time, if there's volatility like we have now, you're buying a lot of shares at a low price when it's down. And in the future, as you could see from the earlier example, it really adds up over time. So there's no need to time the market. Your paychecks every 2 weeks kind of do that for you.
And I know for me, I'm just a set it and forget it person, and dollar cost averaging is how I've done all of my investing. And that has, got me, on target with my goals for retirement over the years. And I was able to save for my kids' college too. So,
And for car repair.
and for car repair.
Yeah, no, but Jen makes a really good point. Just to go back to that emergency fund, the last thing you want to do if an appliance breaks down or your car breaks down is go into the retirement plan. Because if you're under 59 and a half, you're talking about a 10% penalty, plus probably 20% federal tax, plus 5% state tax. You're going to pay an awful lot to net the amount you need to fix the car.
Right.
So that's
And
why,
if you have to do it, obviously you have to do it. But if you can set yourself up in a different way, you want to do that.
Yeah, and that's why Jen's waterfall is important, that you set up the emergency fund before you put money into vehicles that you can't get it back out of.
Yeah.
Yep. So that's important.
Okay.
So diversification, we have our handy Callan chart here. So if we can go right to that, Callan is a person that does a lot of advice for institutional investors in New York City and wealthy families. For some reason, they decided to share this with everyone, all their wonderful research. So it's available. You can Google it. But what it shows is kind of year by year what the top investment was by year, like in the top row, next row down, second best investment that year, third, et cetera, et cetera. And what it shows is it's all over the place. If you were just invested in one of these sectors, you might have a big year one year, but lose money for the next 3 or 4 years. So that's why it's important to be really diverse. So, in these retirement plans, they do have stock funds like CREF stock, like the Vanguard Total Stock Index Fund that buys all of these. It just buys every single sector on the stock side. On the bond side, they have total bond index funds. The bond funds aren't doing as well right now. A lot of you are probably in the default mechanism, which is the time, horizon fund, where basically, you're going to gear it to a 20, 35 or 40 or 45 retirement. And you've got this target date for your retirement that kind of buys into all of this and automatically adjusts. So right now, as a young investor, you're okay. As you get older, if bonds continue to falter, there are typically from TIAA some fixed investments you can get to use as a bond substitute. Any questions about that? I'd be glad to help you out. But this shows that you need to be invested in everything, large companies, mid-sized companies, small companies, and growth and value and dividend producing and domestic and international. If you can do it all in one place, that's good.
Yeah, yeah, that's great. And I know the target date funds have been good
Yeah.
for me.
No, the target date funds up to now have worked fantastic. The only downside presently, which hopefully won't persist, is that the bond side of the portfolio, the safe side of the portfolio,
it's an unusual situation.
It's an unusual situation right now. It's not doing that well.
So normally stocks go down, bonds go up, right?
Yeah,
roughly.
Yeah. So they normally have an inverse relationship. For some reason, they've broken up their inverse relationship for some reason, and both markets are falling at the same time. Highly unusual. Hopefully that comes back to the right rhythm. But as you get older and the target date fund automatically buys more and more bonds and less stocks, if it stays out of whack, there are bond substitutes that we can talk about.
Okay, that sounds great.
Yeah.
And I think this slide just kind of walks us through some of the most common forms of investments. We've been talking about stocks, bonds.
Yep.
Obviously, there are cash alternatives, and then mutual funds and exchange traded funds are ones that do what you've been talking about, right? About buying a little bit of a lot of different companies or
exactly.
Yeah.
Exactly. So within stocks, as I mentioned, you've got large cap, mid cap, small cap, growth value, all different types. What a mutual fund does is invest in all of those for you. Some of them are geared to just one type. It's all large cap, or it's all mid cap, or it's all small cap. So you can do that and buy a whole bunch, or you can do it all in one fund, like the ones I mentioned earlier. Bonds, same thing. You've got government bonds and corporate bonds. Within corporate, you've got highly rated AAA ones from huge companies that are probably never going to default. You've got the other end of the spectrum, so-called junk bonds that pay a much higher rate of interest, but there's risk. And you've got a lot in between. Then you've got both domestic and international. Once again, a mutual fund or ETF can help you buy all the different types of bonds instead of buying individual bonds yourself.
Right.
Yeah, that's how it works.
Yeah.
And then cash alternatives, are like CDs. You can own CDs in a retirement plan. The rates are usually different. You can have money market funds within a retirement
It's more like
plan.
a settlement fund, right?
Yeah, it's a sweep. Yeah.
So if you're earning interest, then you might need to set that you're going to reinvest with the this is why I'm not supposed to leave the fund. But I know I have a settlement fund.
No. So
you can't reinvest.
Yeah, what Jen's talking about, that there's a couple of ways to use cash in your retirement plan. One is by default, you have no choice. The people that run the stock and bond funds automatically have a cash fund for a couple reasons. If there's something attractive they want to buy, they have cash to buy it. They can resettle the next day and shift stocks and bonds back into cash. And as the bonds and stocks, spin off capital gains, things like that, you're not taxed on them because it's in your retirement plan. They go into that cash and then get reinvested within the next few days. So that's called a sweep account. But over and above that, there's other cash alternatives. Like one of them is the TIAA guaranteed fund, known as TIAA traditional, that pays a fixed interest rate that you can use in lieu of bonds from time to time. So anyway, any questions about any of that? We can.
Some good options.
Yeah. Yeah, absolutely.
All right. So let's talk a little bit about, you've mentioned asset allocation a few times. But then, you want to get into.
Yeah, let's go to personalizing it. So, as we look at asset allocation, we want to kind of zero in on what are you saving for? So if it's retirement, you've got this long time horizon where you can afford to take some risk, where this dollar cost averaging from each paycheck over time, unless something over the next, few decades happens that's never happened before, it's most likely going to increase over time, even though there's volatility along the way. But let's say you're saving for something else, like a house, a car. your kids' education, you want to adjust that and you want to kind of look at it in three buckets: short-term time horizon, money you might need immediately; intermediate, money that you might not need for a year or two, that might be in a CD with a longer, guarantee; and long-term investing that's outside the retirement plan, where you might dollar cost average your way into a very well diversified mutual fund over time. So you want to look at, what are you saving for? What's the time horizon? Match the appropriate investment or savings or CD to that time horizon. So the good thing about the credit union, you can do checking, savings, money market, CDs in all different durations, or investments through my department, all in the same place.
Yeah.
Yeah,
Yeah.
so that's what we're trying to build here for members.
And we have some great rates on CDs. Look for the CD specials that we have. That's my
Yeah,
recommendation.
the CD rates are very competitive right now.
That's for when you want cash and like you have a certain, if I know in a year I'm going to be doing home repairs, maybe I park some in a 9-month CD or something like that.
Exactly right. So, for a car or a new roof or, something like that, or maybe even your kids' education, if your kids are already in their early teens or something like that, the time horizon is such where it doesn't make sense to take risk in the stock market. You really want to make sure that's safe and you have a guaranteed rate of return. The longer time horizons are really the only ones appropriate for investing in stocks and bonds and mutual funds and ETFs, at least right now with all this crazy volatility that's going on. And of course, your risk tolerance, some people just aren't comfortable. If you're not going to sleep at night, you might even want some of your longer term investments in something more suitable. You have to be comfortable with it.
Yeah, and we have the next couple slides walk through, the difference between someone who is very conservative or careful about or worried, maybe even and someone who's more aggressive
or old like me,
or whatever, maybe. So well, this shows a 20-year time frame, I think. So it does show that for both folks who have a conservative asset allocation model and an aggressive, they've had ups and downs, but they both have had a pretty decent average annual return. And I think that's the long-term message, as I understand it, about the market, is that it's going to give you that return that hopefully stays ahead of inflation and, gets you to a better place than if you were putting your money in your mattress or something like that.
Yeah.
Just losing value.
The mattress return is not as good.
Good.
Yeah.
So I don't know if you want to say anything about this conservative person's portfolio.
Yeah, there's two scenarios where this makes sense. One is someone with a very low tolerance for risk and says, look, I'd rather, go for the average annual return of 6.19%, because I just can't sleep at night if there's an 08 crash and we're down like 40% like I was in 08, right?
Yeah.
So that's one reason you would go conserve. The other reason is, if you're in one of these target date funds, it automatically goes from aggressive to conservative over time.
Yeah, that's nice.
Or if you're managing it yourself, you would want to rebalance every few years, so that you go from, when you're younger, maybe like a 75% stock position, down to something more like you see here with a 30% stock position. This would be a typical person right before they retire, or they're actually in retirement already. They want to go conservative just in case there is a big crash, their retirement income won't suffer. So that, this is either for a very conservative person or someone that's approaching retirement, wants to take the risk of a big downturn off the table.
Yeah. And then the aggressive asset allocation is kind of more what I did, I guess, early on, saving for retirement.
Yeah.
And you do have those bad years. I've been saving and investing through several crashes now.
Yeah, right.
And so you have to know that, when the market crashes, that is not the time to panic and sell.
No, exactly.
And you have to be ready for those worst years, which you can see here is almost 30% down.
Yep.
In order to have those higher average annual returns. Now, none of this can be guaranteed. Obviously, we need to say that these are just, these are literal, actual portfolios mapped over this time from in the past. We can't say about the future.
No, exactly right.
Yeah,
No, this is
yeah.
based on past data that may or may not repeat itself.
Mm.
It has pretty much over about 125, 130 years. There's a company called Ibbotson, that's the big Wall Street repository for data. And, they've got every, swing up and down for the last 125, 30 years. It's always mapped out this way. It may not in the future. We don't know.
Yeah.
But this is kind of the aggressive model that you would have when you're younger. And so when you're kind of starting out, the stock should probably be at like a 75, 80% level. And as I mentioned, as each paycheck goes in, you're buying a lot of shares when the market's up, or rather a few shares when the market's up, a lot of shares when it's down. Your dollar cost averaging over time. That works particularly well if you have a really well diversified stock portfolio like that Cowan chart that we showed. And again, there's two ways to do that. Go on Morningstar and find out a ton of mutual funds that you should buy. You'd have to manage that all yourself, or you can kind of do a one-stop through Vanguard or TIAA, someone like that. Bonds would be at 20%, cash at 5%. This is to maximize the dollar cost averaging in the stocks. And as I mentioned, Jen, mentioned that she's been in these target date funds. If you really don't have time to look at this, or if just listening to me talk about it gives you a pounding headache, or both, you can just kind of go with the default one where you say, okay, I'm planning to retire in this year, or I think, that's close to it, and it's going to be 2030 or 2035 or 2040, whatever the year is. It will automatically start you out in this aggressive and ratchet you down to conservative by the time you retire, which is kind of nice.
Yeah. And we've been talking about dollar cost averaging, but just can we give an example of
so
it?
let's look at this numerical example. So this is what I was talking about. You get paid every 2 weeks. You invest $100 in the retirement plan every 2 weeks. Market's up, $6 a share, 16.7 shares. All of a sudden, whoa, tariffs on, tariffs off. Wall Street reacts, something happens, and it falls in half. And you buy, a lot of shares at that low price. Then when that 33.3 shares that you bought in month two, when that goes back up 10%, you're up 10% on a lot of shares that you bought at the trough. So that's kind of nice.
Sometimes I like to think of it as the market's on sale.
Yeah.
So, when people are like, oh no, the market's crashed, it's terrible. I'm like, I just keep putting the same amount in every month. And I'm like, and the market's on sale, I'm buying more.
And you don't worry. And then when it's up to $8 a share, you're only buying 12.5 shares. So you're not going to get hurt too bad if that comes back down.
Right.
And over time, this really works well. Especially if you rebalance correctly or let the target date do it for you. You're going to be buying a lot of stocks when you're younger, fewer and fewer as you get older. And this will pay off over time based on, as we say, 100 years of data.
Yeah. We've been referencing retirement, but let's talk a little bit more about it, since for most of us, that's a big portion of our investments. So at the minimum, we're trying to get our employer match, as we talked about. And even if there's no employer match, I guess we had a suggestion of, contributing about 6% early in your career. But obviously, if you're dealing with debt or some of the other pieces of the waterfall, you're going to be doing those first. Then one of the nice things that I've just done as a default, just a way of understanding how I think about money, is when I get a raise, until I got to the point where I wanted to be saving in my retirement, every time I got a raise, most of it I just put into my retirement. And maybe I kept a little bit, so I felt like I had a little mad money or something, but I was used to living on the lower salary. So that's worked well for me, because it's sort of like, otherwise you never want to bump it up, but you kind of don't notice it as much if you do it at a time when you're getting a raise.
No, exactly right. So I think this 6% kind of target came from a lot of 401k plans in the for-profit sector. Will match 100% on the first 3%, and then 50% up to 6%, and then nothing above 6%. So,
Okay, interesting.
it kind of goes that way.
Yeah.
In the not-for-profit sector, we have plans that are more generous than that
Yeah,
sometimes.
sometimes. Yeah.
Yeah. So it all depends, but the 6% is a really good benchmark to use. And then, you can go higher. I mean, this year you can contribute up to 23,500
Yeah.
to the 403B if you're under age 50. If you're over age 50, you can contribute 31,000. That's a lot.
Yes.
And so there's a lot you can do once you get through Jen's waterfall. Make sure you have things covered like the car repair and the new roof and the kids' education that's not in the plan, because you don't want to raid this plan and pay big penalties
Yeah.
to get out.
Yeah.
And Jen, you want to tell them about FIRE?
Yeah, so I mean, some of you on this call may be aware that there is a movement called FIRE, and FIRE stands for Financial Independence Retire Early. I'm not endorsing it. I mean, I'm not actually a FIRE person because here I am still working in my 50s, but FIRE is when you save really aggressively in order to be able to either retire early or just have financial independence that could allow you to retire early. So maybe you're saving 50, 60% of your income, living very cheaply. Or maybe not. If you have a very high paid job, perhaps you can save 50 or 60% and still live right, whatever it is. The idea is just something that kind of is very popular right now. And it's an interesting way to think about how do you want to spend your time in your life and what do you want to be doing? And if you want to know more about FIRE, there's plenty of like blogs and things like that that cover
Sure.
it. So if you Google like financial independence, retire early, you'll find lots of information about it. But most of our advice here is sort of more typical, like, okay, you
Yeah.
are retiring on a normal schedule.
Yep.
In order to do that, these are some suggested targets about how much you should have saved by a certain age. And I always, whenever I put this on the screen, I always just want to preface it that you may not be here. Maybe you're 30 and you don't have half of your salary saved as of today in your retirement. There is time to catch up. Dennis mentioned those catch-up contributions.
Yep.
But you do want to start today. If you feel like you're not quite ready for your retirement or you're not in the place you want to be, start thinking about, is it possible for you to contribute more? Do you want to have an appointment and talk to Dennis about what you should be doing? Or maybe you're going to be fine because maybe you want to talk to Dennis and maybe factor in some other sources of income that you think you're going to have. But all that to say, this is sort of suggested.
No, exactly. Like, if you're 30 if you're 30 years old and you don't have half of your salary showing on your 403B statement, it may be because you were doing other things that are on Jen's waterfall. You're setting up you're paying off debt and you're setting up your emergency fund and you're doing all this stuff and you're saying, hey, Dennis, hey, Jen, I can't do both at once. I'm trying to do, so that's okay. If you're doing those other things and you're, not quite at half of salary at age 30, don't worry about it. It's important that you do all that other stuff too. You can make up for it later. These are just general benchmarks to see that you're on track. And then once you get over age 50, you can put in substantially more into the plan. And, maybe some of your expenses like buying a house or educating kids or so, something like that, might be out of the way by then. So you can put away a lot more at the end, and that can really add up.
Yeah. And it all depends. I think the reason there's such a big range here is some people will have a house that's paid off in retirement, and therefore like those expenses are going to go way down. Some people will not, or some people want to have a big splash out in retirement where they travel a lot or do a lot of expensive things. And so there's a range, and it kind of depends on your goals and what you want to be looking for.
Yeah, exactly right.
Um,
Yeah, so I would say if you're managing this yourself, you want to look at it at least once a year to rebalance it. You don't want to rebalance it every month. So by rebalance, I mean, kind of shifting from 75% stocks down to 70% down to 65%. Again, the beauty of the portfolios that do that automatically, you don't have to worry about it. It does that for you over time with the target date fund approach. Or if there's a major lifestyle change, marriage, divorce, something like that, something big that's happened in your life, you might want to relook at it. Or, change in your outlook, you started out on this fire path, but decided, nah, that's not for me. I'm going to change, so I want to put more into my retirement plan. So anything like that, but you should review it once a year. You want to set it and forget it to some extent, let dollar cost averaging do its thing, but you don't want to ignore it for like 10 years at a time. That's which a lot of people do.
Yeah.
You want to avoid doing that. So, hope,
And making sure the right beneficiaries are on your retirement plan in case,
oh,
if you end up passing away, my
mhm.
beneficiary is my kid. Um, but sometimes people don't look at that and they, have an
Uh,
ex-spouse or something like that on there. So,
Yep. No,
I've seen that happen.
I've seen it happen where former spouse gets a big check.
Because this is outside of
Uh,
probate.
yep.
This is
Yep.
not legal advice, but just check your
No, no,
beneficiaries.
check.
This is a good piece
Yeah,
of
if there's
advice.
any kind of life event that would trigger the reevaluation of beneficiaries, just make sure you get in touch with HR and do that. Yeah.
Yeah. Yep. And then if you are already a member with us, we do want to highlight Savvy Money. It's a free benefit for our members. So when you're in online banking, you may have seen that it's like you can check your credit using Savvy Money. It is free. And it gives you real-time updates about, your credit's going up, it's going down. There's a thing where you can visualize what would happen if you did different things, like what would happen if I closed my credit card? Would my credit go up or down? And it can be really useful if you're planning a big purchase or something, like if you are buying a house or something like that.
Sure.
So we're just getting the word out because it's fairly new that you can use Savvy Money. So now you can submit questions if you have any right now. I guess a question that I have, Dennis, is how hard is it to get an appointment with you, and what does it cost for people to be able to talk with you?
Well, I'm not as booked as Callan that invented the Callan chart.
All right.
But I do have a fairly busy schedule. There are a lot of walk-ins. I'm at the Harvard Square location, the headquarters, Monday, Wednesday, Friday. I'm at the Mass General branch on Tuesdays, and I'm at the Longwood Medical area branch, which is where most of you guys are on Thursdays. We are going to open that new branch at 1 Brigham Circle at some point in the next few months. We're going to keep both open in the meantime at Longwood Medical, which is kind of right across from Dana-Farber, right in the Jocelyn building, or what used to be the Jocelyn building, on the ground floor. So, if you want to get in touch with me, my contact information is in the slide deck. Be happy to meet with you at the branch that best suits you. And it sounds like most of the folks on today's webinar, I could meet you at Longwood on any given Thursday.
Okay.
If you want to go in person. If you want to meet by Zoom, we can do that too. If that's,
Oh, yeah.
yeah, that's
Yeah, that's
better.
a good option for some people.
Absolutely.
Okay. So this disclaimer that this is not this is educational, it's not tax, legal, or investment advice, because obviously Dennis can give you investment advice, but he can't do it without seeing your information.
Yeah.
So, this is all just sort of illustrations and examples. And again, we'll send out the slide deck with Dennis's contact info. And Dennis mentioned we are going to have a new branch opening soon. We're really excited. It's going to be at 1 Brigham Circle. And if you know that location, it does have parking. So we don't have parking in the current branch in Longwood. So we don't have a date yet, but look for it this summer. We'll be doing a ton of announcements when we have the new branch, and some specials and things for folks coming into the new branch. So that it's going to be really fun. And then the old branch, or the existing branch at Longwood, is going to stay open into the fall, so probably around October 1st closing, and that's because the hospital does need that space back. Unfortunately, they're doing a whole renovation and a capital campaign. So we would love to stay in both, but we can't. So there will be overlap though, and so if you're used to going to our Longwood branch, you'll see lots of announcements there. And so with that said, I will thank you all for taking time out of your day to think about your financial wellness, and hope this was of use to you. Thank you, Dennis.
Oh, you're
And
welcome.
I appreciate having this kind of conversation, because I think that, it's important to realize, as much as we've all been watching some interesting economic news, that there's still some constants about the market and things that we can kind of expect. And we've all been through ups and downs, and we'll be
Sure.
through more. So thank you,
Yes.
everybody.
Thanks a lot.